I'm still waiting for your checks to avoid value traps.
Okay. I think, so when you're buying companies, who are value traps are usually in cyclicals, I would say, cyclical businesses, where you think, okay, PE looks 2 or 3x to you, or price to book 0.5, 0.6. You think, बहुत सस्ता है. So, but how do you avoid value traps in this? So when you're buying a business at those valuations, there's a reason for it, right? Historically, things haven't been good, or the expectation is it will continue to be bad. But there are certain business cycles, I would say. So I will give an example of commodities, right? So commodities, my view is if you buy a commodity company at 0.5, 0.6 price to book, the probability of you losing money is very less. So what do you look at these senses? Is something which has happened last 2-3 years changing now? And I again give you an example, not naming a company. So suppose an XYZ company has done huge capex in the last 3 years. And during that time, the cycle for that particular sector industry was not that great. So if you look at the balance sheet today, it will be a horrible balance sheet, right? With high net debt to equity ratios, interest coverage ratios very low. But if you see at that point of time, the cycle is turning around, and that sign you have to really work hard, right? See what's happening to the particular sector, what the competition is doing. And when you get confidence, things are going to turn around. That's when you say, okay, now I want to invest in this company. They have done the hard work, taken the pain in last 3 years, you take it. Value trap is when you just go and buy this company is cheap, let me go and buy it without understanding or analyzing the business. So that's how I see it. And one example, I mean, if I can add that, Ankita, so this is how I talk to bankers or fixed income colleagues of mine, right? At certain point of time, an equity investor would like to give money to these companies because they're at the bottom of the cycle, the balance sheet is bad, and things can improve. A debt investor will not give. A time comes when a debt investor is ready to give money because the cycle has been good, the company's balance sheets have improved. As an equity investor, you feel okay, Abhi, things have done, the stock is fairly valued, let's try to book profits out of it. So that's how I look at the value, and are there any traps into that number, what you're saying?
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.